And so there are calls now for the reverse repo program to be shuttered, which would flood $2.3 trillion right back into the banking system and destroy money market funds that are heavily invested in by people with brokerage accounts. Well, hello there, my friends. Rafi from the Endgame Investor here with this week's Silver Report for Arcadia Economics. And we've got a lot to cover today. A lot of crap has happened. The people in various alphabet soup banking groups are starting to figure out that the $2.3 trillion of reverse repos are what's draining money out of deposit accounts and into money market funds. Basically, all of reverse repos are in money market funds, which means that the weakest banks that do not have any extra reserves are getting killed by the fact that the Fed is paying interest, about 5% interest on reverse repos, all that money that the banks couldn't house from the printing of 2020 and 2021. And so there are calls now for the reverse repo program to be shuttered, which would flood $2.3 trillion right back into the banking system and destroy money market funds that are heavily invested in by people with brokerage accounts, like everybody. And you want to see what that means? I'll show you in an email I got from my broker today. The fun part is that some people in the Fed think that it can drain this $2.3 trillion from its balance sheet with no adverse consequences. Well, isn't that just swell?
It's craptacular.
This week's Silver Report is brought to you by Fortuna Silver Mines, symbol FSM, and we have news coming out yesterday, April 12th, that production results for the first quarter are meeting expectations. Gold and silver production are on track to achieve 2023 annual guidance. It says here, Fortuna reiterates its 2023 annual production guidance range of 6.3 to 6.9 million ounces of silver and 282,000 to 320,000 ounces of gold, or between 412,000 and 463 gold equivalent ounces. Of course, those gold equivalent ounces will go way up if the gold to silver ratio drops closer to the historic monetary range of 50 to 1. I don't think it'll get there immediately, but that's where it is heading in a monetary crisis. So we'll see what happens by the end of the year, including, it says, lead and zinc byproducts. And so Fortuna Silver Mines, symbol FSM, has got gold, silver, and lead, the three elements you need to survive the end game. If we take a look at the chart of FSM, the weekly chart, we see some very healthy technical action here, a bounce off of the 50-week moving average, very bullish. FSM, it looks like it's about to break through the 200-week moving average at 441. We're now at 418. Probably a little bit higher today since gold and silver jumped, and you're watching this on Friday, and it's Thursday as I'm recording this. So the last time that the stock broke through the 200-week moving average, that was just before silver squeeze in June 2020. And here we have the silver squeeze high of about 936, 985, $9.85. So I think we're going to get back there. Yes, I do. And I think it's going to be much more sustained on this run. Fortuna is not hedged against silver. That means it will reflect the rising price of silver as the metals start to catapult from the realization that the Fed has to cut interest rates probably back down to zero sooner than most people think. And now here's a nice little quick thing that I found on Trading Economics. Egypt is joining the hyperinflation club. This is food prices in Egypt that are now rising about 63% annual. Once you have the prices of basic necessities doubling every year, that's when the public gets a little bit nervous about the money substitute problem and starts dumping it for gold and silver or any kind of stable value. And now we're talking about the Fed turning around on interest rate hikes to interest rate cuts, and these rumors are very substantiated. I think we are done with the interest rate hiking cycle. I don't think we will ever see an interest rate hike again in this monetary system, and I said that a few weeks ago, I think. So here we have the technical confirmation of that, and basically we have an uptrend in interest rates from in the 10-year yield here from about 0.53 or something like that, and we had a hit of that trend line in late 2021, and we have hit that trend line again, gone slightly below it right here to about 3.41. If this trend line is tested, it's going to break through, which means that we are on the verge, in a technical sense, of the Fed severely cutting interest rates again, because, well, yeah, the banking system is in trouble, and we've seen that, obviously. And now One thing I want to say about inflation, we came out with a CPI that was below expectations and also a PPI, a producer price index that was below expectations. So either this is a trend down in consumer prices or it's just a bottoming pattern in the CPI. And I think this is a bottoming pattern. And I have this chart to show evidence of why I think that is the case. The blue line here is 1 year inflation expectations. This is forward looking. This is from the Fed itself, the New York Fed. And we have here a strong move up in 1 year inflation expectations. I think this is 0.5% or 0.5% or what you would call 50 basis points. And this is the first rise in 1 year inflation expectations since October 2022. So I think that the CPI and the PPI have bottomed. And once the Fed does cut back to zero and start cutting again, which could be as soon as this month or May, then yeah, consumer prices are going to start rocketing up again. We're already seeing gold and silver start to move. Gold near all-time highs. Right now it's at 2050. I don't know what it's going to be by Friday. By the time you're watching this, it could be at new all-time highs. But remember, and when gold hits new highs, it's usually big players that are hoarding and not the public. When the public catches on, it'll be silver, and the public is usually slow to catch on. But when they do, we'll start seeing silver move seriously, and that gold to silver ratio descend to it. I believe it hit 30 to 1 in 2011, and eventually in a full monetary crisis, it will hit close to 15 to 1, and that is when you have to start buying stuff with it. Now, this is the 30-year treasury rate minus the 3-month treasury rate, basically as far out as you can get of long-term versus short-term rates. And this is the most inverted yield curve ever. We're at negative 1.38% or negative 138 basis points. And this is one of the reasons that the banking system is in serious trouble, because if short-term rates on deposits should be so high by just putting them in money market accounts, then you can just suck money out of banks and put them in money market funds so that banks don't have deposits anymore. And then they go bankrupt, basically. That's what's happening. Because this yield curve is so inverted, that is why banks are losing deposits, because you can get such a high rate on short-term treasuries and reverse repos or wherever you want to put it in the short term, that there's no reason to put money in a bank and keep it there. And now we see here from the 3-month yield just broke through today. This is Thursday, April 13th. The 2007 peak of 5.19 briefly, I think the yield was up like 18 basis points or something. It has gone back down again to about 5.03%. But briefly, we did hit the 2007 peak in short-term interest rates. Is this going to cause a banking crisis? No, because the banking crisis is already here. It's going to get worse until the Fed cuts back to zero. And then what's going to happen then? Well, watch this. This is overnight reverse repurchase agreements, treasuries, securities sold by the Federal Reserve in temporary open market operations. There's a bunch of banks that have way too much money on their balance sheets, way too many dollars that it costs them too much money to house. So they give it back to the Fed, and that right now is about 2.553 trillion, looking at this quarterly chart. And I want to show you something very uncanny. This is reverse repos. You earn basically the overnight rate. I think it's like 4.5 or 5% or something like that. Who cares what it is? It's a lot more than you can get in deposit, which is basically zero. And so if we move to this chart, whoa, it's like the same chart, except what is this? Money market funds, security repurchase agreements, Federal Reserve reverse repurchase agreement operations assets. So how much money, how much money is in reverse repos from money market funds? $2.34 trillion. If you go back to this chart, the total reverse repos that exist are $2.553 trillion. So basically about 90% or more of the reverse repos are money market funds that are using the Fed to get yield for their money market funds. You want some proof of this? I got it in my inbox today. Here is an email that I received from my broker, Interactive Brokers, today. Email from my broker, or why banks are failing. You are missing out on additional interest income at IBKR. Dear Rafi Farber, that's my whole name. Now you can all steal my identity somehow. It has come to our attention that you may be inadvertently missing out on some interest income that you would be entitled to at Interactive Brokers. IBKR pays interest on instantly available qualified cash in your account at 4.33%, and you are currently enjoying such interest. That's great. I'm so happy. To the extent you hold other amounts at any other bank or broker, you are most likely foregoing similar income because most banks or brokers pay very little, if any, interest on their customers' instantly available cash holdings. Would you please pick one option below? After clicking your answer, a new browser window will launch to record your response. Here's the key line on the bottom here. Interactive Brokers pays interest 0.5% under the Fed fund rate to customers on their instantly available cash holdings over $10,000. And so, Interactive Brokers wants me to take money out of any deposit accounts I may have and put them in cash in my Interactive Brokers brokerage account. Am I going to do that? Personally, no, I'm not going to do that because I know where they're putting it. They're putting it in money market funds. And you know what? I'm not so sure about money market funds these days because the calls are starting to start sucking out reverse repos out of money market funds and back into the deposit arena where banks need them to survive. And what happens when you suck $2.3 trillion out of reverse repos overnight? Well, money market funds get broken, and I might never see that money again. Am I giving you any advice? No, I'm just telling you what I would do. I wouldn't want to put my cash into a reverse repo, even though it earns interest, because the whole thing is incredibly unstable. This is from April 5th from what American Banker. American Banker. Stay away from me. Bank crisis puts money market funds back in the spotlight. Now listen to these words of wisdom here from the Bank Policy Institute, which is an institute that's in charge of bank policy. Some of the sharpest criticism of the facility's growth, meaning reverse repos, has come from the Bank Policy Institute, a bank lobbying organization, which accused the Fed last week of aiding and abetting would be better, aiding and abetting a draining of deposits from banks. Policy experts outside the banking industry also say the Fed's engagement with money market funds through both its overnight reverse repo facility and other actions have given those funds advantages over banks, ones that do not always benefit the broader economy. So, money market funds, they don't benefit the economy, but deposits, they benefit the economy. How is that? The whole overnight reverse repurchase facility, listen to this. This is great. This is like silver. Should be unwound. The whole facility should be unwound. How? Basically $2.3 trillion should be slammed back into the banking system overnight. Karen Petrow, managing partner of Federal Financial Analytics, said similarly, the Fed should stop sitting on trillions in bank deposits. It's a huge distortion. Fed officials, including Governor Christopher Waller, have described increasing use of the overnight reverse repurchase facility, which has primarily been driven by money market funds, as we saw and I showed you in the graph, as excess liquidity in the financial system. Because of this, he said the $2 trillion of regularly tied up in that facility could be shed from the Fed's balance sheet with little consequence. Get that? Get that? Little consequence. Taking $2.3 trillion out of reverse repos where people with brokerage accounts like me and other people have stuffed them in reverse repos through their brokerages. And if all that money gets pulled out of money markets and back into deposits, into the money supply, little consequence. Well, what happens when reverse repos are pulled out and the money market funds can no longer invest in those things? What happens to the money market funds? Everybody tries to redeem at the same time. You could break the entire thing. But, whatever. Why do I even try to convince them? But it gets even better. Fed can shrink reserves by $2 trillion without missing a beat. Waller.
You mean shrinkage?
Yes! Significant shrinkage.
I think women know about shrinkage.
It shrinks? Why does it shrink?
It just does.
This is what Waller is saying. We have the standing reverse repo facility, and everyday firms are handing us over $2 trillion in liquidity they don't need. They give us reserves. We give them securities. They don't need the cash. Waller said, it sounds like you should be able to take $2 trillion out and nobody will miss it because they're already trying to give it back and get rid of it. Exactly. There's like $2.3 trillion that aren't doing anything for anybody. Let's just all put it back in the banking system so the money supply will increase by $2.3 trillion overnight and see what the hell happens to consumer prices. I wonder. Another one from Axios, March 31st, 2023. The $2.3 trillion Fed program banks hate.
Hate. I'm using the word hate here. Hate.
I have filled my heart with hate.
Here's another Fed official, Richard Clarida, who used to be the Fed vice chair. He says the bottom line, what happens if you take $2.3 trillion out of reverse repos and put it in the money system, in the money supply overnight? He says the bottom line, to a first approximation, if the reverse repo facility were to go to zero, as it did in 2017, it didn't in 2017. I don't know what he's talking about. That would be roughly $2 trillion more that would flow into the banking system. Former Vice Fed Chair Richard Clarida said Wednesday in a panel in the National Association for Business Economics. I do think at some point the Fed does have to think about what is the role of the reverse repo facility, Clarida said. He added that it worked well for its purpose of keeping a floor under interest rates during his time at the central bank, but it's not doing that now. And he ends like this. It's a question mark, and I'll leave it at that, said Clarida. It's a question mark. It's a question mark what happens when you take $2.3 trillion and you put it in the banking system all in one time. People, we got dangerous people that are in charge of this monetary system. They don't understand that $2.3 trillion is a lot of money. Even with the falling value of the dollar, $2.3 trillion is still a lot of money. And there is a lot of brokerages that are using these reverse repos to give cash yield to their clients. And what happens to them when the money market funds that they invested in all get redeemed at one time? You could end up breaking the buck and causing a huge earthquake. Do these people know about it? I would hope that they do, but I don't know what they even know or think or imagine. It's kind of scary, but you don't have to be scared and you don't have to worry that much. All you got to do is abandon the fake money of these clowns and stack real money, gold and silver, of course. We are not far away from the Fed's final pivot to zero. The gold and silver markets are already anticipating it, with gold possibly at new highs by the time you are watching this, and silver starting to catch up again. And with people in charge of the dollar that don't understand that $2.3 trillion moving from money market funds into deposit accounts has little to no consequence, there's a lot of danger out there, and you need metals to protect yourself. This is Rafi of the Endgame Investor with this week's Silver Report for Arcadia Economics, and I'll see you guys next week, and who knows what will happen to those $2.3 trillion by then.
I don't know how you guys walk around with those things.